Hi there, James Good with an On the Money Market update for Monday the 17th of December. Now I just wanted to take a couple of minutes to point up the peculiar significance of the levels we just hit in the US stock market as represented by SPY, the ETF for the S&P 500. Now on Friday it closed at 142.11, or let's just call it 1421. But let's go back to the first time it ever hit that level on July 16th, 1999. From there a correction began, and the next time it hit that price was on the cusp of the year 2000, where it formed this area of congestion, heavy congestion, burst up into New Year. And then a second correction followed, in which it was repeatedly tested from above and below this level, until when it finally broke up through that level, it fired the index up to the March peak, which was of course the very top of the bull market. Later on in the year, it served as a level which was retested, and the base of the final push up into the last rally of the bull market formed an area of congestion, a range just above it and below the 200-day moving average as it was turning down. And when it finally broke through 1421, that was the final straw, and it formed the first lower low of the bear market. That was the beginning of the end. So when you take a look at it in the round, you see how 1421 essentially formed the pivot between the bull and the bear. Fast forward 7 years, which is the next time SPY approached these levels. It struggled through again around the turn of the year, took a correction, regained 1421, and used that as a kind of support to push up to the second higher high. The correction into August of that year then used 1421 as a kind of trampoline to catapult the market up towards its ultimate euphoric top in October. The market came down to retest exactly that level, and then it formed its final rally into December of that year, formed a range again below the 200-day moving average as it was turning down, and then when it finally broke 1421 in January of 2008, it was the last straw, and it went on to form the first lower low of the bear market. And again, it was retested later on in April of 2008. So once again, it's proved the pivot between the bull and the bear. Are we going to repeat this pattern into the turn of 2013? Well, let's take a look. Here we are in 2012, and it's deja vu all over again. 1421 proves a rally stopper. First in the spring, and then briefly in the summer, an area of congestion, before, well, it took the combined power of two central banks to burst it up through and take it to its high in September. And in the ensuing months, it's been trying to hang on to those gains. First, it formed a head and shoulders, which failed, and head and shoulders are often extremely bullish when they do fail because of the short covering involved, and now it's formed an bullish inverse head and shoulders here with a neckline here, as you can see, which it's now retesting. That target's in excess of 1500. So the key now is to stabilize around this level, around 1421, and if it does hold, I think we are likely to repeat the pattern of the two previous tops and break to a third and perhaps final high sometime in early 2013.